In this presentation, we will take a look at dividend income with regards to tax preparation. We are still up top in our tax formula in the income line, so we're considering components of the income line. First, we'll think about what dividends are and some issues related to dividends. Now, note that the tax data input for dividends will be fairly straightforward because, once again, we should be getting a 1099 form, which will help us to populate the information. But there is information that we need to understand so that we can interpret what the data input form is doing, as well as to discuss if there's things like tax planning purposes as well, and just to be able to communicate with the clients about dividends and what dividends are, why they're having the effect on the tax return that they are. So first, what are dividends? Dividends are distributions to shareholders. So when you think about a dividend, you're typically thinking of a corporation, typically a C corporation as opposed to an S corporation or limited liability company. And oftentimes for most people, you're talking about dividends that are invested into like publicly traded companies. So generally you're thinking about oftentimes when you're thinking about the dividends that have been received, you could be thinking about publicly traded companies. That would be usually the case, although C corporations are going to be a type of corporations that may not be publicly traded that still have the dividend type of distribution, and then that's different than an S corporation, which is like a flow-through, or a limited liability company, which is like a flow-through type of company. So normal situation, you've got a publicly traded company, someone invested into it, and therefore is going to have dividends with it. Now, the thing with dividends you want to keep in mind is there's a debate over the taxation of dividends because of this thing of double taxation. And you want to just basically have this in mind. Note that if you were owning a privately owned corporation, and let's say you owned a privately owned corporation, what would happen is the corporation would then generate revenue. The corporation is thought of as a separate legal entity, and therefore the corporation actually files its own tax return. So if you have a C corporation, typically larger corporations will be C corporations, not necessarily publicly traded, but larger corporations, right, might want a C corporation structure as opposed to an S corp or a limited liability company. And if that's the case, the corporation's being taxed, although, of course, the owners own the corporation and the owners are the shareholders, right? So the corporation is paying tax on the earnings that they have earned, whether or not they have distributed the earnings. They're going to pay the corporate taxation. Then, so the IRS is already collecting tax from the corporation that's filing the tax return for a C corporation. Then, of course, we as the owners are hoping that the corporation generates money and then gives us that money, and we call that a dividend. So a dividend is very similar to a draw for a sole proprietorship. If I was a sole proprietor or a partnership, my business would make money. We would then pull the money out, call it a draw. We're not going to be taxed on the draw. We're going to be taxed on the revenue that the business earned. Well, here with a C corporation, it's different. We're actually going to be taxed on the C corporation is being taxed, and then when the money is distributed to the owners, it's going to be taxed again, right? So the government takes a piece at the corporate level, and then when the money's given to the owner over here, the government taxes it again. Now, I'm not trying to justify this on one way or the other, or argue that it should or should not be taxed at this point. The point is just to understand that the rationale for this is that when you're talking about large companies, like publicly traded companies, this investor in a publicly traded company often is actually not actively involved because they're just passively investing in the company, and therefore this is basically thought of as more of a passive income, which is some kind of justification for having this kind of double taxation, which may or may not be justified. If it was a small company, a very small company, you would think they'd be set up as a sole proprietor or S corporation possibly, and then you'd have a pass-through type of entity, which would be similar to a sole proprietorship and therefore not have the double taxation. And so there's kind of rationale for that. But so why would you want to know this? One, you want to know this so that if you do have tax planning of people that are thinking about organizing a company and they want to set up as a corporation, it's nice to have some awareness of this double taxation. You could look into it in more depth. And you also just want to know the concept of what a dividend is. A dividend is a corporation that is actually generating earnings, just like any business, and then paying it out to the owners. So it's just that the owners now have to pay taxes on the payout, Why would they be paying taxes on the payout? Isn't the corporation paying tax at the corporate level? That yes. However, with large corporations like publicly traded corporations, one argument is that the owners are basically passive investors, are not actively involved, although they could be voting and for the board of directors and whatnot in that format. But because they're more passive investors and whatnot, they're subject to basically the taxation on that double taxation. So you just want to have a framework of what is a dividend, what's the difference between a dividend and interest. Interest is an investment. If you're talking about normal investments and you had money, someone had money to invest. If they put money just into a bank for a savings account, they may be generating interest on it. However, the interest will typically be fairly modest, very low at this point of what the interest rate will be. If they invest in something like stocks, then in equity, they're actually owning a piece of the company and they're hoping to get a larger return on that due to the performance of the company. And the dividends represent the accumulation of income that has accumulated, the retained earnings that have been accumulated by the company that are then distributed to the owners who are the shareholders. So when you own stock, you're a shareholder, you're getting distributed the money. So that's basically the dividend. When you hear dividends, it's often combined with dividend and interest, because these are two forms that we typically think of as more passive type of income. Money making money. We put money in the stock market and it's making money, and this person oftentimes not doing anything because they're a passive investor, possibly in publicly traded companies. All right, types of dividends. There's two different types of dividends that we want to think of: ordinary dividends and qualified dividends. So whenever you think dividends, you have to break them out in your mind: ordinary dividends, qualified dividends. Ordinary dividends are taxed at the ordinary income rate. When you think about high income individuals, this is bad because the ordinary income rate will typically be higher than any other rate that they can have, right? So it's because if they're in a progressive tax system, we could think of their ordinary income rate as, in essence, being applied here at the top rate, right? So that's not good. They would rather have some other kind of rate. Well, the IRS then says, well, in order to incentivize investing, because we want people to invest in our U.S. companies, in our stock companies, we want to encourage that. And the double taxation thing kind of disincentivizes that, is the idea. Then we're going to say that if it's a qualified dividend, it will be taxed at lesser rates. So you may still be taxed on it, but at least it won't be taxed at the highest individual rate, even though you are still technically having some type of double taxation, one on the corporate side, one on the individual side. So the qualified dividends are made from the earnings and profits of the payer corporation. That's what a typical dividend is. It's made from the earnings. The company makes earnings and then pays it out to the owners. And there could be payouts that aren't that in that case, right? They paid out the capital, the original investment, but we won't get into that. Are from domestic corporations or qualified foreign corporations. That's the key, right? So if we're investing in domestic, and that's what the government's trying to incentivize with this. If you invest in domestic corporate, if you invest in essence in our stock market, or who we think is going to be beneficial for us in terms of the U.S. stocks here, then we'll give you a tax benefit by not taxing you at what could be your highest ordinary income rate, but a lower rate. So that's going to really complicate our tax calculation now, but it's either going to be 0, 15, or 20, and that's going to be dependent on the level of your taxable income, how high your income is. So qualified dividends, if you want the 0 rate, if the taxable income is under. So you're not going to pay any tax on qualified dividends if married filing joint filing status is at 78,750 or lower. Or if you're head of household, 52,750, or single, 39,375. You're going to be paying 15% if you're in between these areas, above these numbers, but below these numbers. Married filing joint, 488,850. Head of household, 461,700. Single, 434,550. Again, those will be the filing statuses we have to deal with. The filing status. Okay, so then if you're over these amounts, then of course you're going to be paying the top rate, which is going to be the 20%. So if you're over those amounts for those filing statuses, then you'll be at the 20%. The dividends forms is going to be pretty straightforward. Again, it's going to be a 1099 like this. Who's going to be distributing or giving the 1099 form? Typically the broker organization, the people that are managing this, the form. Now, usually when people are investing, they're going to be investing with some type of financial institution. The financial institution then is the one that the IRS is going to be requiring or pressuring to make sure they do the reporting of the dividends. So the dividends then will typically be received in this format. It may not look exactly like this because they might use their own kind of format in terms of the size and shape of the form, but the information will be the same. So we'll have the numbers here will be the same, and you can then double check this. If you have a question about any number on the form, even though it doesn't look the same, you can then go to the IRS website. We'll actually provide a copy of this as well and look at the instructions. It should be on the back of this form, or you should be able to go on the IRS website and take a look at the instructions. And although the shape of the form that you receive from the broker may not, from the financial institution, may not look exactly like this in size and shape, the numbers should still line up. And if you have a question about a particular box, then you can go to that particular box. Things like you might see something in 2C, like a section 12 or 2 gain or something like that. You could have gains that are basically a distribution of some of the capital, and that's why you might have some of these other boxes that would be filled out. You also could have the foreign tax paid boxes filled out. And generally, if you go to the instructions and you use software, then between those two, you can basically figure out, what's going on with it, even if you've got something kind of more unusual. Now, the typical thing that will happen is, of course, you will have the total ordinary dividends. So total ordinary dividends, and then you'll have the qualified dividends. Now, the ordinary dividends, the qualified, either these two numbers will be the same, or the ordinary dividends will be higher. In other words, the ordinary dividends will basically be all the dividends, and then the qualified dividends will take the amount of them which are qualified. So if we had 10,000 total dividends and they were all qualified dividends, they all qualify for being qualified, then you'd have 10,000 in both sides. If you had 10,000 ordinary dividends and 700 of them were qualified, you'd have the full 10,000, all of them up here. Of that 10,000, 700 of them then being qualified. How's this going to be reported on the Form 1040? This is the first page of the 1040. We see here on line 3A, where we have the qualified portion. There's the 10,000. And then on 3B, we have the full amount. So the full amount is 17,000. Of that 17,000, 10,000 of them are qualified, and therefore 7,000 of them are not qualified. We have a similar kind of setup as we did with the interest, whereas if we have more than 1,500, we are also going to be having a separate schedule, that schedule being a Schedule B. So remember, Schedule B we saw when we saw the interest as well. That's why when we say interest and dividends, we kind of put them together. They're on the same Schedule B if you're over that 1,500 amount for interest, or in this case, dividends. And one reason that could be that they put them on the same form is these are both kind of passive income. In other words, if you make more money than you're consuming, then you're probably going to be investing. The types of investments that you would then make would be into savings accounts or CD accounts earning interest, or putting into stocks which you would be earning or hopefully generating dividends on. So here's the dividends of the 17,000. That's going to be the full amount. So the 17,000 here. Now, also note that when you think about the tax calculation now, it's more complex, because now, if you look at this taxable income, you're at 117,000, but now you're thinking, hey, but some of this dividend amount, the 10,000 of it that is now qualified, isn't going to be taxed at the ordinary income levels, the normal progressive tax levels. It's going to be taxed at either 0%, 15%, or 20%. So now, although you have the 117, it's even more complex to calculate the tax. So if you think about the tax, you're going to say, all right, you got the progressive tax system, but you're going to have to pull out, 10,000 of this, and then the difference, the 107,000 is going to be taxed at the progressive tax rates, and then the 10,000 is going to be taxed at either 0, 10, or 0, 15, or 20%, depending on the taxable income. Again, software will help out with that, but you want to be able to understand that so you can explain it to the taxpayer. They might ask, well, why are these two broken out? What does it matter? 17,000, you got 10,000 here. The bottom line's the same. It's at 117,000. Well, the reason is because once you get to the actual tax calculation, once you get down here to the 104,800 and you actually do the tax calculation, you're going to have some of it that's going to be taxed at ordinary income rates that are going to be using the progressive tax system. And then some of it's going to be taxed at the lower income rates, 10, 15, or 20. And you can tell them that you are getting a benefit from the qualified dividends by being taxed at typically a lower rate, whatever that lower rate they would apply. How do you know that? How can you see that in the calculation? The software is going to help us out with that calculation. And typically the software will give you, show you that calculation, although if it'll probably make someone's eyes roll over if they look at it. But you want to be able to kind of explain it explain that to an individual when you're thinking about the qualified versus the non-qualified dividends.